Again, we have a distorted yardstick. It's when we measure things, whether you're in Europe or Japan or wherever you are, you use your fiat currency to measure whatever asset you're measuring. It's constantly distorting. It's as if you built a house and you had a yardstick, and it took you a couple years to build the house, but the yardstick grew every month. No, it didn't change from 36 to 37 inches. It still said 36 inches, and yet it really was growing. It still said the same value, the same unit of measure. Can you imagine how distorted your house would be from the beginning process to the end if your unit of measure was changing all the time? Okay, that's what it does to price. It does it to stock prices. It does it to commodity prices. And fortunately, the one asset that does keep its value over the decades is monetary metals. Sometimes it'll underperform that rate of increase in money supply, for example. Sometimes it'll outpace it, but generally it keeps its value decade to decade. That's not true with most other assets. Let's take, for example, go back 25 years, summer of 2000, July of 2000. Stock market then was in a pause zone prior to a top. S&P 500 has gone up 3.5-fold over that 25 years. Gold has gone up 11-fold over that 25 years. Gold has kept its value versus the constant decay in the money unit. So that's its importance. And whenever we get to a top or a bottom in a market, what tends to, the reason momentum is helpful is it takes you a half step away from just using price. Because what momentum measures is the change, the relative price of that market in relation to a dynamic that it primarily sets in motion, namely its moving averages. So if you have a dull market that's going nowhere, most of its moving averages are doing the same, going sideways. But if you have an asset that's rising sharply, then its moving averages will rise sharply as well. That's primarily caused not by the ongoing degradation in the money unit, but the actual action of the asset in relation to that money unit. When a market is about to top, when we plot an oscillator, we see structure, an uptrend, prices going up, momentum's going up. But we can plot structure on momentum just like price chartists do with price charts. They draw trend lines, they draw floors, they draw ceilings. We do the same with momentum, and invariably, momentum will set up a structure that when you look at the price chart, everything looks joyous, upward curve. But when you look at the momentum chart, it's possibly a repeated floor that it keeps using and using 2-3 times. Finally, on the fourth time, let's say, it doesn't hold that support and breaks the structure of momentum. At that point that occurs, usually price is not yet telling you anything, is not warning you that it's about to puke. Okay, so it was true at the bottom. Gold, for example, we turned major bearish on gold back in early 2012. Price of gold then had seen its high 3 months before at $1,920 US. It dropped down into the 1600s and rebounded, spent all of the year 2013 going sideways, but below that high, well below, usually in the 1700s. High had been 1920. Already 3 months off that high, in dropping from that $1,900 high, it broke a multi-year uptrend on momentum, which you could not see on a price chart. But it told us, backbone broken, do not trust this beast anymore. It's going down. Well, it took it 1.5 years to finally get the message, but it did. And in 2013, it basically crashed. Cut in half by 2015. Same was true at the bottom. You were barely off the low in February of 2016. Gold was $1140. Its low had been $1050. We put out a report that said, that's it, bull market engaged. Nothing has changed since then. All those momentum metrics that we look at, looking for structure to break, we're not even near stuff like that. So the trend is solid momentum perspective. And that's the way we look at markets. Momentum almost always gives us a warning. In other words, when you go into the stock market bear, where one, it's perceived to finally be a bear, that may require us breaking through 4,800 on the S&P, which, by the way, when we got bearish in January, the S&P was 6,100 area, made a high at 6,200. And it dropped, and in the middle of that drop, we put out a report saying, watch out, there's likely to be a bounce point at 4,800 S&P and at 16,500 on the NASDAQ. They both stopped almost precisely at those numbers and bounced. Now, the bounce was bigger than we thought. In fact, made new highs. But as we look back, we realize, this is what happened in 2000. We get bearish in January, there was a drop, and in March, a new high. Didn't go anywhere, but it was a new high. Same in 2007. We thought we'd peak at a certain level, and they peaked right at our level, but that was a Fed rate cut. It was a surprise Fed rate cut that topped the market. I'm kind of hoping that we're going to get a rate cut to help top this market, because if you go back and look at 2000 and you put a tombstone at the point where the Fed finally started cutting rates again, because they've been in pause, just like now. January 2001, not far off the high, 2 rate cuts in 1 month. First time in a year or so. 2007, after a year and a half of no rate rises, they finally cut rates. In mid-September 2007, the market peaked 3 weeks later. That was it. It was a tombstone that says Fed rate cut. You could put it on the price chart. That's what we don't have yet. And I'm kind of hoping we get that. Just, market is a point in history, because when the Fed starts to panic, it's not good news for the stock market. Rate cuts aren't good. They're indicating something's on fire and they're hosing it down. And anyway, so you get a couple more bad data points. Don't be shocked if the Fed cuts rates. But I suspect this time the stock market's going to be a little wiser. There's already enough doubters out there. And if you drop, like I said, a couple percent below where we're trading right now during this week, and the number will adjust up next week, I think a rollover is going to commence. And that will upset people when they see us, we're back below the 2025 early year highs. I thought we broke out. And when you get back below those highs, they'll realize it was a false liftoff. The rocket's coming back to the pad. You get my point. Anyway, that's where I think we are. And it'd be lovely if the central bank will start to panic. We shall see. Last time around, it was energy in that late 2020 to early 2022 move, where the Bloomberg doubled in a year and a half. Energy tended to be at the front end of that, oil prices, in terms of percent gain. Grains had a pretty good move, but I'm not so sure it's going to be energy leading this time. I think energy will be dramatic because we have a very clear, not a price level, but a momentum structural breakout that will occur if you close any month during this quarter at $70. Next quarter, it'll adjust down a bit. We're a few dollars below there right now, like pushing at it. You slip out and close over that average, which happens to be the 3/4 moving average of oil. There's a structure there, meaning when you plot an oscillator momentum chart of crude oil, you would see a trend line you can't believe the precision of it. When you look at a price chart, you cannot see that structure. In other words, getting over 70 doesn't mean much when you look at a price chart. From momentum, it smacks you in the face. It says, I'm coming out of here. That will probably be very coincident with Bloomberg getting up over 106.50 on a monthly close anytime this year. Annual momentum of Bloomberg is positive, but in the recent pullback, it slipped back below its 3-year average, which in and of itself wasn't structurally important. It's just you cross below the average. Sometimes that's not important. It's the structure on the oscillator. But over the last 2 years, there have been multiple rallies by the Bloomberg, each like 4 or 5 rallies, that each time they get up to 106.50 to 108 in price, there's a ceiling. And they can't close a month over the 3-year moving average. It's a structure. In other words, if you looked at it, you'd see a structure you can't see so well on price. You close over that number, it's saying, I'm up out of the base. I'm breaking out of my base. I'm reasserting the ongoing trend which commenced in October 2020. This is the next wave. And I think this time the Bloomberg will be in sync but lagged to gold. Like I said, commodities don't always move with gold. There are a couple periods in time they have. Stagflation in the late 70s. Stock market was a wasteland. Commodities exploded. On the tail end of gold, which was already exploding. Then again in 2006, 7, and 8, commodities exploded, along with gold, and so forth. So I think they're about to get back in sync so that when you look at the horizon of categories and say, where was the best place to put my money? Well, there's a slightly awakening investor crowd in the U.S. that's finally realizing maybe gold. I think Europeans and Asians have long known this. But the Americans, for some reason, are lagged to that. They're very underinvested in gold and gold-related. Gold has been the ongoing place to be, but suddenly you'll look at commodities and say, what's going on here? I thought Trump was going to keep it under control. And it would ambush people intellectually and emotionally if that category started to turn up for no particular reason, other than, of course, it's cheap historically, and the money flow from the central banks goes somewhere. And investors finally say, hey, I think I'm going to put it in commodities. They're cheap. But also look at commodity stocks. That's a great place to be, I think. Agricultural related, energy related. But wait for the Bloomberg breakout, and we time that. And wait for the crude oil breakout. And they're literally just a few percent above where they're trading right now. And I don't think they need a headline to break out. They'll do it on their own with no particular reason. Then you'll start to gush, and then maybe some headlines will occur. But I think that's a place to put money right now. If you're gold, silver primarily, secondarily, commodity assets.